Hey, so I recently found and answered the question on Quora asking, why did the role of the Federal Reserve expand beyond controlling inflation? Well, first of all, it's important to state that the Fed aims to foster the economic conditions which achieve stable prices, specifically stable inflation, and also maximum employment. So as the lender of last resort, the Fed has always cared about more than just the inflation number. Nevertheless, the Fed has recently been conducting a review of its monetary policy framework, which takes place every 5 years. And during this year's annual Jackson Hole speech, Chairman Jerome Powell spoke about the evolving monetary policy framework, which, especially after being covered by mainstream news media outlets in whatever sense, they may have sparked some confusion alongside the change of monetary tone, which the Fed will adopt from here on, as there are major changes. And I will be kind of covering some of the big changes, key takeaways, I'd say, specifically from the Jackson Hole speech. So I'll be putting up extracts, I'll be reading them, and kind of explaining them in some detail. So first of all, one of the first key takeaways I will talk about, I quote, "A series of historically long expansions had been more likely to end with episodes of financial instability, prompting essential efforts to substantially increase the strength and resilience of the financial system," end quote. So this, in essence, talks about the, liquidity injections through asset purchases, the different various loans and funding facilities which the Fed has instated, operates specifically from the Corona crash in March. We'll be seeing more of that. It will become more commonplace. If it isn't already, of course, that is to say, in order to maintain financial stability, strength, and resilience, at least in their line of thinking, that is how it's going to operate. So, as per the analysis, the Fed indulging into more of what modern monetary theory proponents advocate for comes in the form of, obviously, financing large deficits, large fiscal deficits, and at low cost at that. So this will allow, or at least in theory, this is going to allow the economy to run hotter for longer. So as per the previous business cycles that we've observed, just recently we had the longest bull run. As per, if we look at the stock market, we'll be seeing more of that. More of that perhaps will be breaking records cycle after cycle. We will see, but there is definitely going to be some shift in our cycles with more intervention and different kinds of intervention, corporate bond buybacks, and the different forms of liquidity injections with whatever else the Fed may come up with in the future. More intervention is going to cause more distortion in terms of what we see today and tomorrow and from here on in terms of history, perhaps. We're yet to see specifically. On the other hand, reputational problems may arise with the increasingly accommodative monetary policy approach, which isn't only increasingly accommodative, it's also increasingly accommodative for longer periods of time. For example, I made a video talking about the Fed's interest rate announcement until 2023, or through 2023 specifically, and the kind of effects that it may have on the stock market. It's a new environment that we're going to be within, and so I guess the problem that some people may have with this is the argument that current monetary policy helps recreate the conditions that are its justification. So we're talking about low growth, low productivity, and very high indebtedness. For example, there is literature studying zombie companies. So this very low cost debt, low cost borrowing environment that we have for a long period of time, it helps sustain unproductive firms. And it helps sustain this kind of monetary transmission mechanism. So the way in which money gets from the lender to the borrower, specifically to maybe inefficient borrowers, it leads to exactly inefficient uses of funds, of loans, of money. And inefficient, we mean, we get less bang for our buck. There is decreasing marginal return in terms of the more money we put out in loans, it's going to seek into different kinds of businesses, more businesses in general, and some of these businesses may be less effective, maybe zombie companies which soak in a lot of funds, can be very highly indebted, but don't have the output, the increases in output that we would like to achieve when exercising this very accommodative monetary policy, right? So that's, I guess, the first kind of key takeaway, and that is the focus on monetary policy from the kind of lens of the liquidity injections, where we're talking about financial stability or instability. We're looking at resilience and strength and the importance of such, since that is what has currently been ending our bull runs, our, business cycles, as opposed to in the past. We would have the economy overheating, we would have high inflation due to high employment. For example, here what we have is stock market crashes, financial crashes, which target people's wealth. So, for example, we have a lot of people invested in the stock markets, bond markets, different capital markets, essentially, from which firms get their funding, into which obviously people invest. And when that crashes, the whole system of the whole financial system has been certainly, when it does take a hit, has certainly got a net effect on the wider economy, right? So people's stocks fall, they may be less wealthy, from which they spend less. Well, it definitely hurts the consumer sentiment if they hear all the crashes, and especially reminiscent of the great financial crash from here on. And people in my generation, well, we're very susceptible to something that has happened quite recently. I am currently 21. I didn't live through the great financial crash in terms of me having lost all my money, or, my, for example, parents. I don't remember anything specifically. But, for example, this corona crash, well, it's all very vivid to us. And especially more so to businesses and people investing in it, higher susceptibility is going to cause, a cause for higher intervention from their perspective, and kind of higher concentration of action in terms of achieving financial stability, whichever way that is they do it. Second key takeaway, we're talking about employment, and I quote, "In addition, our revised statement says that our policy decisions will be informed by our, quote, assessments of the shortfalls of employment from its maximum levels, quote, rather than by, quote, deviations from its maximum levels or level, quote, as in our previous statement." So, end quote. I guess, in essence, what this shows is, or really showcases, is the evolving, changing data and academic literature talking about how a sustained and strong labor market has not, at least over the past decade, caused a breakout of inflation, right? So employment goals changing in response to this kind of economic and academic literature, it showcases the evidence where the Phillips curve is becoming flatter than it has been in the past. So in economics, the Phillips curve showcases the relationship or trade-off between unemployment and inflation. So traditionally, high employment or low unemployment has caused, and long periods of high economic growth has caused higher inflation, right? So that is kind of the trade-off. If we have very low unemployment for a long period of time, we're going to get high inflation. And so what that would cause is, again, the overheated economy. It would cause a crash, the inflationary spiral, as we saw in the 80s during the Volcker period. We saw the inflation, very high, persistent inflation, have sincerely negative effects on the economy, society, I guess in general, the whole structure of our economy and the well-being of people, financial well-being of people. So, today, that relationship has been changing, right? It's been observed to change. Specifically, we've seen that actually we can sustain a very strong labor markets. We can sustain lower unemployment for longer periods of time without there being a breakout of inflation. In fact, over the past decade, the US has not been hitting its inflation target of 2% on average per year. It has been undershooting that target, even though, again, there's been a very robust market, the economy has been growing, etc. This means that, again, the Phillips curve, the literature is changing, and therefore maximum employment is something that we can achieve more so than we thought so in the past. Specifically, what this does mention, again, is the idea we're talking about the shortfalls of employment rather than the deviations, suggesting that a positive deviation in terms of overshooting our maximum employment target will not cause contractionary monetary policy unless it does lead to rising and high inflation, which, again, isn't something that we've seen. We have been seeing over the past decade as per the CPI and the way that it is calculated. So just a quick note onto that. The Fed aims to now promote employment in as a means of kind of making economic recoveries more inclusive. And that is to talk about tackling inequality. Really, that's kind of what it's talking about: economic inequality, wealth inequality, and by making economic recovery more inclusive, you're encapsulating more people in the labor force and also more people who are capable of working. So an interesting point to take into account is the labor force participation graph. Now, specifically, we saw a collapse in labor force participation during the corona crash, unlike any other. And so when taking into account employment, unemployment, we also have to take into account how many people are in the labor force in respect to the age group within which it is appropriate to be working. So, for example, if only 15% of people aged 18 to 45 or 55 or 65 are working, we may have a very low unemployment simultaneously, but again, that working backwards, that doesn't mean that the economy is in great shape, right? So we can have 0% unemployment, 10% unemployment, but it's also very important to take into account how many people are participating in the labor force out of the kind of age group wherein it is appropriate to work. Just another tool for analysis, which isn't always mentioned. We always hear unemployment figures, we always hear employment figures. Again, there is always more to take into account when analyzing policy and economics, etc. Third point is to do with inflation. Specifically, that was widely covered in the news. It deserves a lot of attention, of course. Inflation is almost a commonplace word now, but there is obviously much more to it. It's very complex at the same time, so it's important to understand it, or at least be aware of what is going on with it and how it's being targeted. So I quote. Therefore, following periods where inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. End quote. So, in essence, this means that the Fed will allow the inflation target to overshoot its 2% long-run target for a certain period of time, because again, the 2% is a long-run target. So for example, out of 100 years, if for 50 years it undershoots it and we're at 1.5%, well, for the next 50 years, we need to overshoot it by a bit to, again, over 100 years, whatever the long run is, have a long-run target of inflation being 2% actually being achieved, so that people keep on expecting it, right? So I guess the idea of flexible inflation targeting, which this kind of taps into, was brought to light by Ben Bernanke, which was the Fed chairman during the Great Financial Crash. But together, I guess together collectively, what we're going to be seeing now is a further decoupling of asset prices from economic and corporate fundamentals, of course, but as per high and sustainable economic growth without financial disruptive bubbles. I believe that this will rest upon politicians to develop more of a pro-growth, pro-economy policy framework to, again, allow for the economy to prosper, whilst shining a spotlight on productivity levels, which is something that we need to target, and also maintaining kind of household financial security and avoiding household financial insecurity on an individual level, right? So people aren't susceptible to stock market crashes. People are building up savings, which is very hard to do in an environment with non-existent nominal interest rates. But that's, I guess, based on opinion. Anyways, that's really that. The main three kind of takeaways in terms of liquidity injections as per the financial stability, employment, and inflation. Those are three major topics, along some other minor points, but these are general topics. These are very important topics, and the kind of key takeaways that people should definitely be aware of when looking at the Jackson Hole speech, and specifically in the Fed's role of controlling inflation and much, much more. So as mentioned here, just to kind of conclude, we saw the Fed speak about financial stability, the 2% target, long-run inflation, and the maximum employment. And they're achieving this through debt monetization, non-existent nominal interest rates, and paycheck protection, alongside others. But that will be all for this. I hope you took something away from it. I do suggest also checking out my previous video on the interest rate and the stock market effects of the interest rate, which is set until, well, the end of 2023. And also, I will be posting some articles which I've written on the topic, which go into more detail, more depth, specifically on what the Fed has been doing in terms of its monetary policy over the past few months, since March as well. So that'll be all. I hope you guys have a great day, great week, and goodbye.